Hi guys, this is Sia Jane and welcome back to my channel ACCA and beyond. So in this video we are going to be talking about chapter number 2, which is tangible non-current assets. If you can see, I've already done some markings over here because I already made a video, but I accidentally lost it. I clicked delete, so I have to record it again. So I'll quickly give so in the last video we were talking about revenue grants, and we had stopped over here, and we are going to be talking about capital grants for this video. So according to IAS 20, it permits two treatments to treat a capital grants. First is we write off the grant against the cost of the non-current asset and depreciate the reduced cost. I'll have to erase it. 1 second. So let's say a grant, we have purchased a non-current asset for, let's say, worth 50, and we receive a grant. Our grant value is for 10, and we have 5 years. The asset value is for 5 years. So what we are going to do is just we'll set off this 10 from the non-current asset price, and we'll have 40 as our asset price, and 40 needs to be depreciated over 5 years, which gives us our depreciation as 8 per year. So this method is quite simple. The second method is quite tricky, but if you understand it again, it's simple. So in the second method, we treat the grant as deferred credit and transfer a portion to revenue each year, so offsetting the higher depreciation charge on the original cost. So of course there is going to be sum below, and we'll solve that sum, but I'll just give you an example. Let's see if I can make an example. 1 second. Okay, so let's say again we have a grant, we have an asset value of 50. Asset is for 50, we have grant for 10. What we are going to do is, and asset life is 5 years. So what we are going to do is we'll write the asset as a 50 only in our books, and we'll recognize this grant also over 5 years, which gives us 2 per year. So for 50 and 5 years, our depreciation will be 5, obviously. So we'll state this in our profit and loss, and this 2 also we'll also take it into our profit and loss. This is a loss, so this 2 also will take into our profit and loss, and this will be our profit. So it's in a kind of a way we are setting it off against our depreciation, right? So there's obviously going to be a sum below, which will make things more easier and simpler to understand. My example is quite difficult, I guess, or maybe not. I'm not taking right amounts, so we'll solve a sum below. So let's read about treatment of capital grants. Grant for purchases of non-current assets should be recognized over the expected useful life of the related assets. IAS 20 permits two treatments. Both treatments are equally acceptable and capable of giving a fair presentation. Just the two methods above which we talked about. So on initial recognition in method 1, deduct the grant from the cost of the non-current asset and depreciate the reduced cost, what we have talked about. In second method, recognize a grant initially as deferred income and transfer a portion of revenue each year, so offsetting the higher depreciation charge based on the original cost. So we'll we'll recognize it as a deferred income in a statement of profit, statement of financial position, and each year we'll recognize it in a profit and loss. So method 1 is obviously far simpler. Method 2 has the advantage of ensuring that assets acquired at different times and in different locations are recorded on a uniform basis. So this is an important point. This can be asked in your theory, in your section C or anything. So yeah, remember this. Regardless of changes in government policy. In some countries, legislation requires that non-current assets should be stated by companies at purchase price, and this is defined as actual price paid plus any additional expenses. So our purchase price is, let's say we bought an asset for 50 and we had to pay 5 more rupees for transportation cost, or maybe to assemble the equipment. So that is also going to be included in our purchase price. So legal opinion on this matter is that enterprise subject to such legislation should not deduct grants from cost. In such countries, method 1 may only be adopted by unincorporated bodies. So in most countries, we have to recognize our non-current assets at the purchase price only. We cannot directly deduct grants from them. So obviously we cannot use method 1 in those countries. They can only be used by unincorporated bodies, the method 1, but other than them, no one can use method 1. So obviously they'll have to use method 2. Now let's do this test your understanding. an entity opens a new factory and receives a government grant of $15,000 in respect of capital. 1 second. Yeah, in respect of capital equipment costing $1 lakh, it depreciates all plant and machinery at 20% straight line basis. Show the statement of profit or loss and statement of financial position extracts in respect of the grant in the first year under both methods. So we'll solve this sum using both methods. Just let me split my screen. Yeah. So okay, so first method, what it is with this method is very simple. I hope no one makes a method in mistakes in this method. In this method we are just going to, what is the value of a non-current asset? It's $1 lakh. So we'll just deduct this 15,000 from our $1 lakh. I'll write it down. So this gives us 85,000. So this 85,000 is going to be a non-current asset, and we'll write this down in a statement of financial position. This is just a, so let's make this our statement of financial position, and over here I'll write non-current asset, which is worth 85,000. Now on this 85,000 I am going to be charging depreciation on a straight line basis for 20%. So 85,000 into 20% is 17,000. So in our statement of profit and loss, I am going to be writing depreciation as 17,000. So this makes our non-current asset as depreciation, our total non-current asset as 68,000, if I'm correct. Let me just check again. 85 minus 17, 68,000. Yes. So this is very simple. We are done with method 1. This is all you have to do in method 1. Now method 2 can be quite tricky, but stay with me. So what do we do in method 2 is we are going to be recognizing this is as a deferred income. So first of all, in my statement of let's say financial position, I am going to be recognizing this asset as it is. So my non-current asset will be for 1 lakh, and my depreciation, they have told me to charge depreciation on straight line basis, right? So in my statement of profit and loss, my depreciation will be 20,000 because 20% of 1 lakh is 20,000. This is my loss. Now we have a government grant for 15,000 rupees. Now if I'm charging depreciation of on 20% straight line basis, then I'll have to recognize this grant also on 15,000 as straight line basis of 20% of straight line basis also. So the method you're using for charging depreciation is the same exact method you will use to recognize your grant. So 20% of 15,000 is 3,000. So I am going to recognize this as a profit in my statement of profit and loss. So this is my 3,000. So indirectly we are not going to offset it directly. Okay, I'm not just going to write 17,000 as my depreciation. I'm going to mention these two things, but indirectly I'm offsetting this government grant against this depreciation. So yeah, sorry. And yeah, in my statement of financial position also I'll have to recognize my depreciation, which is 20,000, and we have 80,000 in a non-current asset. Now in our non-current liabilities, okay, we have a government grant. In non-current liabilities we have government grant, and in our current liabilities also we have government grant. Sorry. Why is that? Because current liability is something which we are going to be recognizing in the next 12 months. Now we have already recognized 3,000 this year, but again in the next 12 months we have to recognize a government grant, which will be 1 second, right? How do I annotate, right? So again we'll recognize 3,000 in the next year because we have to charge again 20%, and the rest of the 9,000 I'm going to recognize after 12 months. So this is going to be my current liability, and this is going to be my non-current liability. I hope you guys have understood this sum. If you haven't, please feel free to comment down and I'll try to explain it to you guys. So just one second, we'll move forward. Okay. So, other types of government assistance may include the provision of interest-free loans or guarantees. These should be disclosed in the notes to accounts. So, of course, our government have some schemes in which they give us interest-free loans and some any other government assistance. This should be disclosed in the notes to the accounts, but it's not necessary to mention it in a profit or loss statements. Now, repayment of grants. In some cases, grants may be need to be repaid if the conditions of the grants are breached. If there's a clause or a condition to a grant, like you have to employ 50 people this year, then you can receive a grant, and if you do not employ 50 people, then your conditions are breached. So if there's an obligation to repay the grant under these circumstances and the repayment is probable, then it should be provided for in accordance with the requirements of IAS 37, which we'll see in chapter number 15. So it's just one second. So it's just saying that if you breach the conditions given in the grant, and you have to repay back your grant amount, then you have to make a provision or a contingent liability, which we'll see later on how we do that according to IAS 37, which is in chapter number 15. If the deferred income method for capital grants has been used, then the remaining grant would be repaid to the government. Any amounts released to the profit or loss may also need to be reversed depending on the level of repayment required. If the netting off method for capital grants has been used, then the cost of the asset must be increased to recognize the full payment of the asset without the grant. A liability will be set up for the grant repayment. So, if you are using method number 2, then what we have in a deferred income, that we'll repay, that will be reversed, and any amount that is released to a profit and loss will also be need to be reversed. So that also depends on the repayment required. Sometimes you only have to repay 50% of the grant amount back. So we'll just have to reverse all of the payment back to the government. And if netting of method is used, then let's say if we net it off 100 by 20, that is a government grant, and we got the cost as 80. Now we have to increase it by 20 again and get it 100. So just we have to reverse all of these things. Now, let's move on to the next section, which is IAS 23 borrowing cost. This is a very simple section. So, according to IAS 23, borrowing cost regulate the extent to which entities are allowed to capitalize borrowing costs incurred on money borrowed to finance the acquisition of certain assets. Borrowing cost must be capitalized as part of the cost of an asset if that asset is a qualifying asset. You'll be wondering what is a qualifying asset. We'll talk about it also. So one which necessarily takes a substantial period of time to get ready for its intended use or sale. So let's say if you one second. Yeah. So what are qualifying assets? Qualifying assets are those which take a long time to get ready. Not just your let's say buildings, or if you're in a manufacturing business and your products take a long time to get ready, these are qualifying assets. And if you take loans to build these assets, then the interest which you have to pay on these loans can be capitalized as the cost of an asset. So when do we commence the capitalization of these interest? So IAS 23 states that the capitalization of borrowing costs should commence when all of the following conditions are met. First, the expenditure for the asset is being incurred. Second, borrowing costs are being incurred, and activities that are necessary to prepare the asset for its intended use or sale are in progress. So, when can we commence capitalization of these borrowing costs? So, these all three requirements need to be met. That you are actively spending something to build that asset. You are actively paying loan interest. Like sometimes you have not yet taken loan and you just no one does that, but yeah, you need to be paying your interest to capitalize that interest also. Activities that are necessary to prepare the asset for its intended use or sale are in progress. It's just not that लोन ले लिया है, मैं कुछ काम नहीं कर रही हूँ, लोन लेके बैठी हुई हूँ और मैं बस उसको कैपिटलाइज कर रही हूँ, ऐसा नहीं चलता. You need to be actively working towards building that asset. Then only you can capitalize the borrowing amount. The rate of interest to be taken. Where funds are borrowed specifically to acquire a qualifying asset, borrowing costs which may be capitalized are those actually incurred, less any investment income on the temporary investment of the borrowings during the capitalization period. I think you will better understand this paragraph after solving this up. So, we'll solve test your understanding 6 and I'll help you guys out. So Wilson received an 18 million 5% loan on 1st January 2018 to finance construction of a new factory. As the funds were not all required immediately, Wilson invested 6 million in 2% bonds until 31st May. Construction of the factory began on 1st March 2018 and was completed on 31st December 2018. Calculate the amount of interest to be capitalized in respect of the factory as at December 31st, 2018. This is a very good sum. It will help you guys clear many of the concepts. Okay, so we have taken a 18 million loan, 5% interest on 1st January 2018, but we read over here the construction of the factory began on 1st March. So for 1st March, for 2 months, Jan and Feb, we are not actually making any doing anything to build our asset. So can we recognize it? No, because activities that are necessary to prepare the asset for its intended use or sale are in progress, and no, over here there are no work has been done, so we cannot capitalize interest for these 2 months. Okay, so we'll whatever we do, we'll start capitalizing it after March. Now, as the funds were not all required immediately, Wilson invested 6 million in 2% bonds until 31st May. 1 second, just 1 second, guys. Yes, sorry, I'm back. Okay, so Wilson invested 6 million. So what we'll do over here, first we'll calculate how much we have to how much interest we were paying. So for 18 million, for 1 second, sorry guys, again there